on to our next topic, which is refinancing and equity. So in 2025, a good time to refinance your home loan with rates starting to stabilize. Is that true?
Look, I won't say they have stabilized. They are on the down.
Yeah.
Every time is a good time to refinance, especially if you are not on the competitive rates.
Yeah.
Look, I guess it's very easy in this day and age when the information is all around you all the time.
Yeah.
There's enough information floating on social media, TV, everywhere, YouTube. And most of our clients know what is a reasonable rate these days.
Yeah.
If you are around that,
Yeah.
then you're fine to a
Retain.
review.
Yeah.
Can we match? Can we go down to that each and every time? In some cases, we do.
Yeah.
In every case, no. It all depends where the pricing is. Look,
what are the signs that it's a time to refinance your existing home loan?
Look, the most common reason we have seen, and you'll be surprised to hear that it's not the interest rate.
Okay.
Yeah. Most common reason we have seen people come to us is that they have not been looked after.
Okay.
That's the highest ranked reason.
Okay.
Yes, rate comes into the play, don't get me wrong, but we don't see majority of them come to us because of the rate. Because as I said, they are not vastly different from each other.
No.
I don't claim that ANZ is the cheapest, but we are not the most expensive either.
No.
We are competitive. Look, I can't find anyone who can help me.
No.
I try to book an appointment, but no one is available. We gave somebody our documents, haven't heard back. I followed up, but no answer. They started, but we are not very comfortable with what they're explaining.
Yeah.
So these are the common reasons we see when people will reach out to us.
How does equity work when it comes to assessing funds for renovations or investments?
Interesting. Yeah, so again, equity is basically the difference between the value of your home and your loan.
Yeah.
In a very basic form. Can you access all of it? No.
No.
Because that would mean that bank is lending you 100% of the value of your loan, of your property, which they can't do.
No.
So the most common way to look at it is look at the value of your home, whatever you think it might be, work out 80% of that value. I'll start with 80% for a reason, then I'll come back to it. Write that number down. From that number, deduct your current outstanding home loan amount, and the difference is your equity.
Okay.
So now you're looking at an equity up to the 80% value of your home.
Okay.
Why you want to look at 80%? Because if you go over 80%, which you can, up to 90, 94, 95, but then you go into the LMI zone, right?
Yeah.
So why would someone wants to borrow 100 or 200 grand to renovate a home and pay a certain amount of mortgage insurance?
Yeah.
Now, I'm not suggesting that everyone should just avoid it. There are situations where it might make sense. For that person to sell the home, buy the new home, it will probably cost them 50, 60 grand in fees and charges anyway. So they are better off just paying a small LMI, access the equity and renovate and stay where they are. So you've got to actually understand the whole picture. But the starting point will be 80%. And once we know more, we can say, hey, look, up to 80% you have an X amount of equity. But if we took you to 90%, you could get another. Whatever.
Depending.
But this would mean that now you're paying LMI.
Yeah. Okay.
Oh, sorry, the other part of this was investments.
Yes.
Yep. Equity will work the same way. Obviously, the funds are now used for investments. Could be buying shares or stocks or buying another property, basically. But essentially, it will work the same way. Borrowing power can differ. When you buy shares, we can't use the future income from those shares because we don't know what it's going to be. But if you're buying a property, there's a future rental income in this scenario, which we can utilize in our current calculations, which then can increase your borrowing power. So borrowing power is not one amount that you can apply everywhere. Each scenario, borrowing power can be different on that same income. Because there are certain things coming into the picture which can change it.
For that top up that you're going to take for the renovations or investment using your equity, again the income serviceability also plays the role, right?
Every time you're going to bank to borrow, irrelevant it is 10,000 or a million, you have to have income and serviceability. If you don't have income and serviceability, it doesn't matter it's a smaller amount or a bigger amount. Whatever that amount is, if you can service it, you'll get it.
Okay. Just a scenario just came to me. If somebody have a property of 1 million, they have $400,000, they want a top up of another 300,000. So the three things, they had a good credit history when they bought previously, but now when they're going to a top up, they have some issue with their credit rating. Can that stop them from borrowing?
100%.
Yeah, okay.
Credit check is one of the major part, but it's the last part of the process.
Yeah.
Think of it like this, that it's given that you have to have a good credit history.
Yeah.
It's not one of those things that can we work without a good one, or you know what I mean. So this is one of those things that if you don't have a good credit rating or credit history, in spite of having good equity, good income, serviceability, everything perfect, you'll still be declined.
Because there had been few years ago, there were issues happening where people were scamming, and I had one client where he had this telephone bill outstanding for few months, and he wasn't aware. He actually never had a connection with that particular company, but that money was owing under his name. So that was somebody scammed him. So
there are some unfortunate people to whom this has happened.
Yeah.
Look, at the end of the day, you just have to trust your customers. You have to trust that they are telling you the truth. But I can tell you from experience, not everyone is.
No.
Right? But you can't really put everyone in the same category.
No.
And it becomes hard for a credit assessor to then make this decision that, hey, I think this one is telling the truth and this one is not. So they have to make some policies where that individual judgment is not required. So the policy says if your credit score is below a certain amount, irrelevant of what the reason might be, yes, it wasn't your fault, but end of the story. If this is the score, you know, look, if it's something very small, and we have had these situations in the past where it was a $300 bill or whatever, if it's a small amount, if it's a one-off, if it's a very old incident, we can appeal it. And in a lot of cases, we have been able to overturn the decision. If it's very recent, if it's very big, and if it's multiple, you can't really argue with that.
No. Yeah. So even if it's a $10,000 top up, you still have to have your credit
100%,
check done.
100%.
Okay.
100%. And in these situations, you also got to look at the overall strength of the application. If this client was asking for a top up of say 200,000, and with that extra 200, his total loan to value ratio was less than 50%, right? His income is enough to give him another million, but he's only taking 200. So these things will come into the play.
Yeah.
Bank will go and look at it, the assessor will go and look at it, and he'll go, look, chances of this customer repeating that issue again is very little. Why would he? So, but if the same situation overturns and this customer is now borrowing 94%, income is very tight, somehow we are just scraping through the 200, then the assessor is not going to be very comfortable approving it, given the history.
Okay. And if, for example, ABC client is borrowing money and they have been to one credit assessor, and then a couple of years later, if they are taking a top up, will they go to the same credit assessor? No.
See, in few years it will be different.
Okay.
But if you take a pre-approval, you found a home and you came back in another 30, 40, 50, 60 days, in those scenarios it goes to the same assessor. Otherwise, because in those teams as well, people are always moving and churning.
Yeah, okay.
There are actually no hidden cost apart of things like, which I've seen sometimes is, hey, if I put a certain amount of redraw, or if I pull out more than a certain amount of redraw, there was a $5 fee. Now it was mentioned somewhere in a little, T&Cs. They didn't see it. Does it impact a lot of people? No, not really. In refinancing, the biggest thing you got to be really aware of is if you are moving a loan which is currently fixed, because you might be breaking a fixed contract, and that could attract a substantial breaking cost. So you really need to find that out before you move ahead anywhere. But hey, if there is a breaking cost, how much it is. And it can change. If you inquire today, it's not going to be the same a month later. Because in that 1 month, if the interest rate environment has changed, if your current bank is offering a different rate for the same term, that break cost can fluctuate from few $1,000s within those 30 days.
Yeah.
So always better to check again to say, hey, is it the same? No, it's changed. Now what is it? This much, okay. And if the cost to break is more than what you're going to potentially save, well, then the answer is pretty straightforward.
Yeah.